Throughout history, power has worn many masks, but gold has always remained the silent force beneath them. Not the ornaments people showcase, but the hidden streams of gold moving quietly between nations and empires. These flows determined victories, collapses, treaties, and the rise of global powers long before public eyes noticed. This is the untold story of the secret gold network, the invisible system shaping nations for centuries. Before dollars, before paper money, gold became humanity's first true global currency connecting distant kingdoms. European empires expanded on the back of gold, financing ships, wars, and early multinational banking families. Official ledgers showed only fragments, while vast amounts vanished into private vaults beyond public knowledge. This marked the birth of an invisible gold web, linking miners, traders, bankers, diplomats, and powerful intermediaries. Gold became the backbone of empires, yet the empires themselves rarely controlled its circulation. By the 1700s, creditors, not kings, dictated the movement of the world's most coveted metal. Real power no longer lay in thrones or borders, but in gold flows hidden inside secretive financial networks. Gold evolved into a strategic weapon, shaping political outcomes long before modern diplomacy existed. Three silent pillars sharpened the network: vault keepers, bullion dealers, and intermediaries managing gold access. Vault keepers became custodians of nations' wealth, storing gold in a few powerful central bank vaults. Their control over access meant that stored gold often influenced politics more than gold in circulation. Bullion dealers fixed prices daily, shaping currencies, war budgets, colonial expansion, and global trade simultaneously. Their decisions regulated international power quietly, with the public never aware of their influence. Intermediaries, the shadow diplomats, moved gold swiftly during crises, revolutions, and collapses. Governments depended on them for survival, even when they distrusted their motives or methods. A clear pattern emerged. Gold didn't follow nations. Instead, nations followed the direction gold was already moving. Every empire's ascent and decline tracked the silent migration of gold long before historians recognized the shifts. This hidden architecture guided the fate of governments, economies, and wars from behind sealed vault doors. As the world marched toward global conflict, gold moved first, revealing truths nations pretended not to see. And when World War I erupted, the gold network would shape destiny on a scale no one yet understood. Gold moved long before the world understood the danger approaching, quietly fleeing nations as tensions rose across empires. Europe drifted into a false calm. Yet beneath the surface, financial elites sensed an approaching storm that governments refused to acknowledge. German industrialists transferred gold into Swiss vaults, while Russian nobles diverted their reserves to Paris and London discreetly. These movements were silent warnings from those who understood that gold always anticipates conflict before diplomats do. When gold leaves a nation, war stops being speculation and becomes an inevitable future forming in the shadows. As 1914 approached, gold movements intensified dramatically while the public remained unaware of the approaching catastrophe. World War I erupted and rapidly transformed into an economic struggle where gold determined survival more than military strength. Nations spent their reserves at alarming speeds and turned desperately to intermediaries who once existed only in financial peripheries. Private bankers and bullion brokers became lifelines as governments realized they lacked the infrastructure to move gold effectively. German forces relied partly on gold loans routed through Scandinavia to finance weapon production during the critical early months. Britain mortgaged vast quantities of its overseas gold reserves in exchange for American credit lines, essential for sustaining the war. Russia pledged its imperial gold to French banks simply to maintain transportation systems and keep the empire functioning. These decisions revealed a hidden truth. Modern nations could not operate without the invisible web managing gold circulation. The war was extended not by industrial output alone, but by a quiet network facilitating the shadow movement of gold across borders. After the war ended, governments discovered their currencies weakened, and their financial sovereignty increasingly tied to external forces. The United States emerged unexpectedly as the new center of global financial gravity due to the enormous influx of European gold. American vaults now held more gold than any treasury in history, positioning the nation as the primary source of post-war stability. Wall Street replaced London as the principal hub of credit and reconstruction financing for a devastated Europe. Nations dependent on American gold-backed loans unknowingly surrendered a portion of their economic independence. This transition signaled a dramatic shift in global power, though most citizens around the world scarcely noticed the change. The public imagined that their gold remained safely within government vaults, yet reality revealed a more complex arrangement of control. A significant share of global gold migrated into a small number of private and semi-public institutions managing international reserves. The Federal Reserve Bank of New York and the Bank of England quietly became custodians of immense foreign gold holdings. These vaults held political influence not through force, but through their ability to grant or restrict access to stored bullion. Gold became an instrument of leverage that operated independently from democratic processes or national pride. In the interwar years, governments struggled to restore the gold standard, believing that stability would follow its reinstatement. However, gold no longer behaved as a simple monetary anchor, but instead functioned as a mechanism enforcing fiscal discipline. Whenever a nation overspent or experienced political instability, gold immediately exited its borders in search of safer havens. Foreign investors demanded repayment in bullion for any sign of weakness, forcing governments into defensive financial positions. These flows were not random disruptions, but coordinated responses shaped by interconnected gold-clearing networks across major cities. London's price-fixing meetings, Parisian settlement systems, and New York's gold corridors reinforced a synchronized global mechanism. Private correspondence among elite financiers influenced international decisions long before public institutions reacted officially. The gold network operated as a quiet hierarchy of trust, determining which nations deserved credit and which were deemed risky. This invisible meritocracy shaped the global economic order far more effectively than treaties or diplomatic negotiations. By the late 1920s, the network had reached peak influence, setting the stage for dramatic upheaval during the Great Depression. The crisis intensified fears, pushing citizens toward hoarding gold and destabilizing financial systems reliant on public confidence. President Roosevelt responded with Executive Order 6102, forcing Americans to surrender their gold to the federal government. This act consolidated national control over gold and enabled massive revaluation for strategic economic advantage. The government profited instantly by increasing gold's value from $20.67 to $35 per ounce after seizure was complete. This decision reshaped the power dynamic, reinforcing U.S. dominance over the global financial architecture. Soon after, the world witnessed the establishment of the Bank for International Settlements in Basel, Switzerland. The BIS became a sanctuary for gold transfers, operating above national politics and beyond traditional regulatory frameworks. Gold stored in its vaults retained diplomatic weight, even when the governments owning it collapsed or fell to invading armies. The BIS emerged as an institution that preserved financial continuity during geopolitical upheaval and war. This transformation marked the moment gold governance became transnational, existing outside the reach of individual nations. As World War II unfolded, gold continued to move ahead of military events, revealing a deeper pattern previously ignored. Nations fell, governments dissolved, but gold remained intact within interconnected vaults forming the backbone of recovery planning. By 1945, gold had once again consolidated within American vaults, setting the foundation for the Bretton Woods monetary order. This was not coincidence, but the continuation of a centuries-old pattern guiding global power transitions. A new world was about to emerge, engineered around the silent authority of gold and the institutions shielding it from public scrutiny. When the nations gathered at Bretton Woods in 1944, they believed they were designing a fair global monetary system. But beneath the speeches and signatures, the system had already been predetermined by the concentration of gold in American vaults. Two-thirds of the world's gold rested in U.S. custody, allowing the dollar to inherit a role traditionally reserved for empires. Gold no longer needed visibility because the scale of its presence silently validated the dollar's new authority. The world accepted the arrangement because no alternative seemed capable of stabilizing post-war reconstruction. Yet beneath this new order, small fractures emerged as countries gradually rebuilt from wartime devastation. As economies recovered, nations realized the dollar's power was inseparable from America's vast gold hoard. This dependence generated unease, especially as the U.S. expanded spending commitments across the Cold War landscape. European governments watched anxiously as dollar issuance grew faster than the gold supposedly backing it. A quiet question circulated among central bankers. What if the promised gold no longer matched the printed dollars? By the 1960s, whispers of doubt became open concern as France demanded gold redemption directly from the United States. Switzerland followed, transporting bullion across borders to secure tangible wealth away from American financial influence. This initiated what historians now call the silent global bank run on the United States. Countries refrained from public criticism yet acted discreetly, exchanging dollars for gold before the window closed. With every outbound shipment of gold, the credibility of the Bretton Woods system weakened visibly. President Nixon responded decisively in 1971 by suspending dollar convertibility into gold without warning. Official explanations framed the move as temporary, though insiders knew the gold-backed era had ended permanently. Currencies now floated freely, but the public did not understand that gold quietly shifted into deeper financial shadows. It no longer moved between nations as bars, but circulated through derivatives, paper claims, and unallocated reserves. Gold became a ghost asset, present everywhere in influence, yet rarely seen in physical form by ordinary citizens. The new system empowered bullion banks, offshore vaults, and specialized brokers who traded gold without ever touching it. Unallocated gold accounts multiplied, creating enormous paper markets dwarfing the volume of physical metal. This abstraction distanced nations from the real asset while expanding the network that managed invisible gold flows. In effect, gold did not lose relevance. It only became harder to trace, or see and observe, or meaningfully challenge. The network adapted, evolving from physical transfers to a structure rooted in financial engineering and concealed leverage. As the 21st century progressed, governments felt confident that gold had lost its strategic importance. Digital payments, credit expansion, and complex financial instruments appeared to replace ancient monetary anchors. But history does not surrender easily, and the world began confronting crises reminiscent of earlier eras. Inflation surged globally, sovereign debt escalated, and geopolitical tensions fractured long-standing alliances. These pressures revived a familiar instinct. Nations quietly began accumulating gold once more. Central bank gold purchases soared to levels unseen since the 1960s, signaling a coordinated shift among global powers. Countries repatriated gold reserves from foreign vaults, fearing political risk or future sanctions. This movement revealed a widespread loss of confidence in a purely dollar-dominated financial system. Russia, China, India, Turkey, and the Gulf states expanded bullion holdings at unprecedented speed. The East emerged as a growing gravitational center for gold trade, reshaping a market long governed by Western institutions. In parallel, BRICS nations explored settlement systems partially linked to gold, bypassing Western financial infrastructure. This development revived debates about whether a multipolar monetary world might emerge from global fragmentation. For the first time in decades, gold reassumed a visible role in strategic planning among competing geopolitical blocs. The traditional gold hubs in London and New York began losing influence as Shanghai and Dubai increased market dominance. A new architecture was forming, not controlled by any single empire, but shaped by competing centers of trust and power. Today, gold's role is again misunderstood by most people who assume its importance faded with the 20th century. But gold has never depended on public attention. It thrives on institutional necessity during moments of uncertainty. Nations turn to gold when trust erodes, when systems strain, and when currencies weaken under political pressure. Physical gold remains the only asset immune to freezing, censorship, or counterparty failure. This makes it indispensable in a world shifting toward financial fragmentation and geopolitical unpredictability. The deeper truth is that no nation fully controls gold anymore. Instead, gold reveals who controls the nation. It reflects economic discipline, political stability, and geopolitical foresight more accurately than official statistics. Gold flows expose vulnerabilities long before currency markets or bond yields react to systemic changes. In times of crisis, the hidden gold network continues operating silently across vaults, clearinghouses, and discrete agreements. It's neither good nor evil, only a mirror of power, trust, and the eternal contest between nations seeking security. As we trace the journey from ancient empires to modern financial institutions, one pattern becomes unmistakable. Empires rise when they attract gold, decline when they lose it, and collapse when trust in their currency evaporates. Every generation believes it has transcended the need for gold, yet history repeatedly proves otherwise. During periods of uncertainty, civilizations return to the one asset unaltered by ideology, politics, or technological trends. Gold endures because it resists control, and in resisting control, it reveals the shifting balance of global power. Today, as digital currencies expand and geopolitical blocs compete for dominance, a quiet transformation unfolds beneath. Gold is reasserting itself, not through public spectacle, but through strategic accumulation by governments and central banks. Its resurgence signals a world preparing for structural change beyond the control of any single nation or alliance. Those who follow the movement of gold will always understand global shifts long before headlines acknowledge them. Because gold remains what it has always been, the silent architect of nations, waiting patiently in the shadows.